It's so much harder than stocks in terms of negotiation of deals, time spent. There's so much more opportunity in the security market than in real estate. Large amounts of real estate have changed hands at bargain prices, but usually stocks were cheaper, but they were a lot easier to do. So there's so much more opportunity that presents itself in the security market.
Warren Buffett just issued a warning for the housing market, and what he said could completely change how you think about real estate. This is coming from the man who's outperformed nearly every investor in history, so when he speaks, it's worth listening closely. Because ignoring this might cost you, or save you, a fortune. Back in 2012, after home prices collapsed, Warren Buffett famously said he would buy up hundreds of thousands of single-family homes if it were practical. He believed that, held long-term, homes could be even better than stocks. But today, he's completely flipped his stance. In his most recent shareholder meeting, Buffett revealed that he no longer sees real estate as an attractive investment. And when you hear his reasons, you might be shocked. Let's not forget, this is the man who's beaten the markets for decades in a row. He's built Berkshire Hathaway into one of the largest companies in the world. If Warren Buffett thinks real estate isn't worth it anymore, that's a big deal. So, what exactly did Buffett say? Let's start here. According to him, it's a lot easier to make money in the stock market than in real estate. His words, it's so much harder than stocks in terms of negotiation of deals and time spent. There's so much more opportunity in the securities market than in real estate. Now, is that true? Let's break it down. Historically, median home prices over the last 100 years have increased by about 4.3% annually. Compare that to inflation, which averaged 3%, and you're really only ahead by 1.3% per year. Doesn't sound too exciting, right? But here's where it gets interesting. With rental income, homeowners can see additional returns of 2% to 6% per year. Plus, real estate comes with something very special, leverage.
New home
For example,
dropped,
if you put $50,000 down on a $500,000 home, and the home goes up to $600,000, you didn't just make 20%. You actually made a 200% return on your initial investment. That's phenomenal. The catch: it's not easy. As Buffett points out, real estate isn't just clicking a button and you're done. It's time-consuming. You have to find the right property, negotiate, deal with inspections, repairs, tenants, property taxes, the list goes on. It's ongoing work that never stops. Stocks, on the other hand, since 1928, the stock market has averaged 9.8% per year, with dividends reinvested. That's without lifting a finger. No management. No maintenance. Just buying a fund and letting time do the work. Buffett's point is simple. For most people, stocks are easier, more scalable, and often more profitable. And that brings us to Buffett's second warning. He points out that when real estate is down, stocks are usually down even more, but stocks also present far bigger opportunities to buy at bargain prices. His exact words, large amounts of real estate have changed hands at bargain prices, but usually, stocks were cheaper, and they were a lot easier to buy. So, how does this play out in real history? Let's take a closer look. Believe it or not, in the last 100 years, there have only been 3 major housing crashes. The first was in 1929 during the Great Depression, when prices fell 67%, and it took nearly 3 decades to recover. The second happened in the 1990s during the savings and loan crisis, when interest rates rose and home construction stalled. Prices flattened, and in some areas even dropped, until about 1997. And the third, of course, was the 2008 financial crisis. Depending on the area, home prices dropped anywhere from 30% to 80%. It took a massive bailout before the market eventually bounced back to new highs. But here's the thing, outside of those crashes, real estate has been surprisingly resilient. Even during recessions, wars, and inflationary periods, housing often held strong or even grew. Which makes Buffett's warning today even more unusual. If housing usually weathers storms, why is he stepping away now? Well, to understand that, you need to hear Buffett's next point. It's not just about returns. It's about time, liquidity, and the hidden costs nobody talks about. In part 1, we uncovered Warren Buffett's shocking statement that real estate simply isn't worth the time or effort compared to stocks. But his reasoning goes deeper than just returns. Today, we're diving into the hidden factors, things most investors completely overlook, that explain why Buffett has steered clear of real estate for decades. Let's start with liquidity. Real estate is notoriously illiquid. What does that mean? If you want to sell a house, it can take weeks or even months to find a buyer, negotiate, close the deal, and transfer ownership. And during downturns, that process becomes even harder. Stocks, on the other hand, can be sold in seconds. Buffett emphasizes this advantage all the time. When opportunities strike in the stock market, he can deploy billions within minutes. Real estate simply doesn't offer that flexibility. And in Buffett's world, speed and scale matter. But liquidity isn't the only issue. Buffett also talks about the enormous amount of time real estate consumes. Think about it. You're dealing with property management, tenants who might not pay rent, ongoing maintenance, rising insurance costs, property taxes, even legal disputes. Buffett calls this an opportunity cost. Every hour spent fixing a roof or chasing a contractor is an hour not spent analyzing businesses, buying undervalued stocks, or growing his portfolio. For him, it's just not worth the distraction. In contrast, when Buffett buys stocks, he's essentially buying pieces of businesses managed by professionals. He doesn't have to manage a CEO's daily schedule. He doesn't fix their offices when something breaks. He just owns a part of their success. That's why he's always said, buy businesses, not properties. It's easier, faster, and in his view, far more rewarding. Remember those 3 big housing crashes we talked about? In each case, stocks fell even harder. But here's the key difference. Stocks also bounced back faster and often delivered greater profits for those who bought in during the chaos. During the Great Depression, for example, stocks lost nearly 90% of their value, but those who stayed invested saw massive gains in the years that followed. Buffett himself built much of Berkshire Hathaway's success by buying stocks during crises. Companies trading at prices so low, they were essentially free money for patient investors. This leads us to Buffett's core philosophy: simplicity. He doesn't believe in making things harder than they need to be. Why chase tenants for rent when you could simply buy shares in a rental REIT and collect dividends without lifting a finger? Why fix toilets when you can own a slice of a company that manages thousands of properties for you? For Buffett, the answer is obvious. Stocks offer the same exposure, often with better returns, and without the endless headaches. So, what does this mean for everyday investors like you and me? Buffett has always been very clear. Most people are better off putting their money into a low-cost S&P 500 index fund. He argues that this strategy will outperform nearly every real estate deal an average investor could get into, especially once you account for time, effort, and hidden costs. His famous advice: don't bet against America. He believes the U.S. economy, through stocks, will continue to grow long-term. And while housing may rise too, stocks are simply the easier, smarter bet. But here's the twist. Real estate isn't going away. Millions of Americans will still build wealth through it, especially those who understand leverage and can manage properties efficiently. So the real question becomes, are you willing to put in the work, or would you rather follow Buffett's simpler path? Warren Buffett's warning isn't meant to scare people away from real estate entirely. It's meant to highlight a truth that many overlook. Stocks have historically outperformed, they require less effort, and they're infinitely more liquid. So while real estate might make some people wealthy, Buffett himself has chosen the stock market, and his track record speaks for itself. What do you think? Is Buffett right to avoid real estate, or is he missing out on opportunities that everyday investors can still take advantage of? Let me know in the comments below. And remember, markets change fast, so make sure you're subscribed, because we'll keep breaking down these shifts in real estate and investing so you're always ahead of the curve. Thanks for watching, and I'll see you in the next one.